Hello everyone, welcome back to our channel. Today, we'll delve into a significant event in stock market history, the Kennedy slide of 1962, also known as the flash crash of 1962. This episode marked a substantial decline in the stock market during John F. Kennedy's presidency. Before we dive into the intriguing details of the Kennedy slide, let's set the stage by harking back to an interview with a prominent figure in the investment world, Warren Buffett, from the same year, 1962.
I think the president's action on steel probably had something to do with the timing of the decline, but I don't think it was the factor which determined the amount of the decline. For some time, stocks have been rising at rather rapid rates. Corporate earnings have not been rising. Dividends have not been increasing, and it's not to be unexpected that perhaps a correction of some of those unusual factors on the upside might occur on the downside.
Well, some observers from time to time say that the stock market is a forecaster of events to come. Can you predict, or would you care to take a look at what you think this might be forecasting, the decline?
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally. For example, the last 4 or 5 years, the stock market has been booming along and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher or thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
Well, in a nutshell, Mr. Buffett, can you give us your opinion of just exactly what happened, what caused it?
Well, there was undoubtedly some forced selling the week when the stock market hit the news. The previous week, prices had declined about 6% for the week on average, and there was some stock that was forced upon the market both by margin calls from brokers and some that was forced out by improperly secured bank loans. And this in turn set up a self-generating mechanism on the downside for a while, which we may have seen the last of and which we may not have seen the last of.
In this interview, Buffett shared some prescient insights and predictions, some of which eerily foreshadowed the impending market downturn. His perspective on the market situation and his investment strategies provide an essential backdrop to the events of the Kennedy slide. Now, with Buffett's viewpoint as our guide, let's delve into the tumultuous roller coaster ride that was the Kennedy slide of 1962. Ever pondered over what transpired during the Kennedy slide of 1962? This significant event in stock market history, also known as the flash crash of 1962, marked a considerable decline in stock values during the presidency of John F. Kennedy. Today we journey through the causes, repercussions, and aftermath of this historical market downturn. The Kennedy slide of 1962 signifies a stock market downturn from December 1961 through June 1962. This period followed a prolonged phase of growth post the Wall Street crash of 1929. The market reached its zenith by the end of 1961, only to witness a precipitous decline in the first half of 1962, with the S&P 500 dipping by a staggering 22.5%. Post the Wall Street crash of 1929, the market was largely dominated by speculative caution and bearish trends. Notably, bear raids played a crucial role in driving stock prices downward. It was during this period that Joseph P. Kennedy, a celebrated bear raider, amassed wealth through stock pools and later ascended to the chairmanship of the U.S. Securities and Exchange Commission. In the run-up to the Kennedy slide, the U.S. was in an economic upswing, mirrored in the rising GDP and stock prices. Contrarily, despite the initial growth, the stock market was hit by a severe decline starting in December 1961. As the slide unfolded, explanations varied. Edwin Posner, the head of the American Stock Exchange, attributed the drop to a market adjustment following years of uninterrupted increases. Investigations by the U.S. Securities and Exchange Commission underscored incompetence but failed to unearth any clear wrongdoing. President Kennedy pondered over various solutions, eventually opting to lower the margin requirement and introduce a tax cut. The public's confidence was bolstered by influential businessmen and fund managers who expressed optimism about the market's future. The market shock had limited immediate impacts on interest rates and the credit market. While the stock market decline was significant, it fell short of the severity of the 1929 crash. The Kennedy slide drew parallels to the Great Depression in terms of market volatility and investor sentiment. To sum up, the Kennedy slide of 1962 serves as a reminder of the stock market's unpredictable nature. Despite the economic expansion, the market experienced a steep decline, demonstrating the influence of speculative behavior and market adjustments. The event also underscores the importance of effective regulatory oversight and the role of public confidence in market recovery. So the next time you find yourself navigating the stock market's choppy waters, remember the lessons from the Kennedy slide of 1962. Lastly, don't forget to subscribe.